Well, we're back on Blockside TV. Jason Fernandes, COO and co-founder of AEToken, joins us online. Jason, great to speak to you again today.
Hi, Jessica.
Great to have you. Now, we're going to jump straight in because we are talking fintech and insurance technology. Actually, it's on the rise, and in particular in the United Kingdom, putting them first in the world, actually. What do you think it is about it that draws the UK to companies to it?
So fintech is hot, and as you pointed out, it's not just in the UK, but the UK does seem to be doing really well in that area. So there are something like 2.5 times more companies in the UK banking and payments industry now than there were in 2005, while globally that number has fallen by about a fifth. And also, Britain has been one of the biggest fintech players in the past year, mostly because of that 9.1 billion euro takeover, because there was a 9.1 billion euro takeover of WorldPay, which is Britain's dominant processor of credit card and debit card payments. And essentially, they were bought by their US rival. And essentially, it was a closing of that deal that helped UK essentially outstrip the US and China in the total amount of investments in the fintech sector. And the main reason it's growing so fast, more so in the UK than in the rest of the EU, is because of the view that regulators have taken and the sort of proactive way that they've been handling the situation. One of the main regulatory boosts that the UK has given it is that they've recently adopted. They had an early adoption of the EU open banking rules that would force lenders to open up access for fintechs to the data and accounts of clients who authorize that. So that was a mandate that really helped boost fintech companies. Another is essentially what the UK Chancellor Philip Hammond has done to support the fintech sector, such as establishing regulatory bridges with other countries. Another is that there's like a £775 million pool of cash that's designed to boost competition in the UK's small business banking sector that's going to be awarded to basically fintechs by the Royal Bank of Scotland, and that's part of orders. It's under orders from the European regulators. So there's a lot of effect that regulators have. But also, a lot of these fintech companies are multi-market, which shows that there's a maturing of the fintech sector in the UK market. And there's also been a lot of innovation out of China and India. But if you take those two markets out, the UK is far ahead of what the rest of the developed world is doing.
Wow, and it certainly sounds like they're doing a lot to really attract businesses, to attract talent as well. If we look at insurance tech, because it's actually becoming very big, if not bigger than fintech itself, why are we seeing such a surge of interest into insurance tech?
So for one, that's because it's an enormous market, and it's an old one. So the amount of insurance premiums recorded in 2013 by the U.S. Department of Treasury represented something like 7% of the entire U.S. GDP. Also, this is an industry that's dominated by very old institutions, as I mentioned. So processes at the carrier level have mostly remained unchanged over the last several years. They really haven't seen a lot of technological innovations. And basically, companies are personnel heavy. So they've got agents, adjusters, and analysts comprising of more than 2 million jobs. And they're essentially all just using legacy systems, basically built around paper documents. So also the average life insurance agent is something like 59 years old. And there's estimates that an average of 3 duplicated processes in every customer sale. And essentially, that's created a time-consuming, costly, and opaque system where consumers are frustrated by the kind of service that they're getting. And so essentially what this means is that it's ripe. It's an industry that's really ripe for disruption. And because mainly, today's world is driven by data, there's a huge opportunity for insurance to leverage data platforms to help improve operations, and that includes everything from sales to underwriting. There's IoT, which has brought things like real-time and near real-time data streaming, everything from environmental sensors to connected devices, wearables. These are sort of things that insurers are going to be able to use to get better real-time, basically managing of risk, improving customer loyalty, optimizing sales. These are things that were not available to insurance companies in the past. And so now, and also even with the customer service, for example, thus far that's mostly meant human processes, but ultimately that's going to have to be automated. And so that's forcing companies to think of a more holistic 360-degree view of social media engagement, mobile app interaction, and a whole bunch of other things that are open to it now that haven't been open to the industry before. So the industry is really old and it's hasn't really innovated. And so this is a sort of like old world money meets new technology, and that's sort of why fintech has exploded, and also insurance tech for that matter.
And you made a really interesting point there where you say kind of like old money and new technologies. And obviously the reason that you come on the show so often is to speak about cryptocurrencies and the cryptocurrency markets. Is there a correlation or is there a link between the success of cryptocurrencies and the interest in cryptocurrencies and the interest in fintech?
So it's not that cryptocurrencies really equal fintech. Because there's a lot of very good use cases in fintech that don't involve cryptocurrencies at all. They're crowdfunding platforms, payment providers like Venmo. Apple is also getting into payments. Also mobile payments, there's insurance, budgeting apps, for example, are really taking off. So there's a lot of use cases for fintech that don't involve cryptocurrencies at all. However, if I were to take like a step back and look at fintech in general, by its very nature, it's about money. And in many cases, that involves transferring, budgeting, or investing of that money. And I think money itself is undergoing a fundamental transition. Ultimately, almost all companies involved in these transactions will eventually or likely shift over to using some form of crypto. And in that sense, the long game for most fintech is likely crypto to some extent. So I think ultimately that is going to be true, but it's not true right now.
And I also want to ask you, Jason, because Bitfinex is in trouble over using funds from Tether to cover up some losses. Do you think this is the only case of this kind, or do you see it as the beginning of the trend?
So I don't think it's certainly not the only time a crypto company has been accused of a scam. There were scams in the past. There will be scams in the future. What Bitfinex is accused of, if proven, is really beyond the pale, though. The entire USP of a stablecoin like Tether is that it's backed 100% by fiat. And the main reasons investors are buying Tether is because they believe that they thought it was backed by fiat. And at some point, Tether stopped being backed by fiat, and people were told that after the fact. So to me, that borders on fraud almost, because people that were buying Tether were being misled. So them using those funds for Bitfinex is even more shocking. You can't use funds that you have basically lying around because you would lie to people telling them that their funds were backed up by fiat, and then use that fund to essentially fund a failing enterprise. So, and not to mention, they were also printing massive amounts of Tether as well. So they had access to even more funds, and that's kind of unforgivable to me.
And also in a world where we are seeing that crypto, and in a business rather, where crypto is being sold for traditional fiat currency, is it possible to keep these two kinds of funds completely separate?
Yeah, absolutely. I mean, you just have separate accounts, right? The whole point that the whole reason people, like I said, the whole reason about people are investing in Tether is because that's supposed to be backed. At least back when they first started, it was supposed to be backed essentially 100% by fiat. So people felt that look, we're essentially buying a stand-in for fiat. So whenever that changed, they really should have notified people, and even just notifying them is really not enough, because there's a whole bunch of people that have already bought into Tether, and those people bought into Tether assuming that the Tether would be backed by fiat 100%. So really, it's unconscionable that they haven't decided, that they started to use funds from one company to another, specifically Tether, which is supposed to be a situation where they're effectively printing money, right? If you're saying you're a stable coin and you're not really a stable coin, and then you're using that money to fund something else, that just seems so incredibly wrong. I'm surprised that they've gotten this far, and I really think that's unconscionable behavior.
What do you think the repercussions should be to the current situation that we are seeing right now with Tether?
Well, I mean, that it comes down to whether they're actually whether investigations are proved accurate or not. But if if it is proved that that's exactly what they did, I don't see how anybody in their right mind would invest in Tether going forward. And I'm really not sure what you would do with pretty much everybody else should be allowed to take that money out at the original promise of 100% back fiat. That's what I would say. I think that Tether should just basically, if this is actually proven to be true, Tether should just fold and give everybody their money back.
That's a really interesting point, so thank you for sharing that. Now, on a final note, if we do look at regulators here, what we are seeing in the crypto space, a lot of excitement. We are seeing markets are up right now, a lot of energy in the space as well. If we turn our attention to regulators, do you think that they are ready for the bull run?
So I don't think anybody was ready for the gains that we're seeing right now. I mean, it's just massive. We're something like 30%, 33% over the last 7 days. Even though many of us felt that it was long overdue, I think it took the entire market by surprise. And it's obviously, a massively good sign. I think regulators are going to be moving at their pace, regardless of whether the bull run or if it's a bear market. They just sort of prod along. It takes uncomfortably long for regulators to get off and get anything done. And we've seen this with the SEC and Bitwise and ETFs. But hopefully, but that's basically the key for institutional investors anyways, is that regulators need to get in. So hopefully when they get done, whenever that is, I don't think that they're going to speed up because it's a bull run, but whenever they get done, that should help to push the market even further, because obviously it would help institutional investors come in with the knowledge that regulators have already come in and looked at it and have put in the proper processes to protect them to some extent.
Fantastic. Well, Jason, it's always a pleasure to hear your insights. Thank you so much for your time today, and best of luck. And we'll speak to you all again very soon. Thank you.
Sure. Good. Thank you.
Thank you. That's all for myself and Jason for this episode of New on the Block. Stay tuned after the break for more blockchain and cryptocurrency updates.